Welcome to everybody joining. This is our first of a series of Lunch and Learns that we're going to run every third Thursday at 1 o'clock, third Thursday in the month. Hopefully you can put those in your diary then, and you'll know that we're always running something. We've got some titles already agreed and subjects, topics that we think would be really informative for you. Always please do suggest if there's anything in particular you want us to cover. More than happy to do things that are very topical, obviously. But we're going to start with something today, which is just a fundamental issue that we see a lot. And we do see funding declines happening, and whether that's because through the accountant putting the deal through the platform, and of course we also take funding applications direct from businesses. Now the business application results are a lot worse than those that come through accountants, which is good to know, isn't it? As accountants, we are obviously a lot better and give our clients much more support. So we want to talk today, though, about how we make sure that happens as little as possible for your client. So what are we going to cover? She says, trying to get the screen to work. Come on, then. Move. There we go. Right. So we're covering, first of all, let me just start with some real basics, like why is funding so important and why should you be bothered about it on behalf of your client? So we'll just cover a few things there that are sort of data points, things that are going on in the market. We'll then talk about what your client typically is going to need funding for. Then we'll come on to the most common decline reasons. Because we're Capitalise, we will talk about credit scores. So important to everything that we're doing now, and we'll explain why. And then Nick's going to really talk about affordability, debt, issues that the lenders are looking to see and understand, and how we at Capitalise can help with that. And then how you yourself can support your client as well. Very important. So why now and why you? For me, I wanted to include this really. It's actually a report that Fathom did last year, and they interviewed lots of businesses and asked what were their concerns. And 34% of them said cash flow was an issue, 23% cost control, 12% funding. Another 12% worried about the economic uncertainty, growth and tariffs and profitability. So most of those all link into what's happening to their working capital, what's happening to their cash flow. And these are the things on their minds all the time. And this is where, as an accountant, if you can appreciate what the business owner is really going through day to day and the concerns they have, and open up those discussions with them, then they're going to realize that you completely understand them and you are, there to help. And that's really what we want to try and get across today. How can you help your client more, and how can they appreciate you more? Now, you may have seen this graph, this chart, which I know it's got a lot of grayed out things at the back, so we want to just focus on the winners and the losers points there. But this has come from a study done by Bain and Company, who are a global research company. And they, you may have seen this, Paul Surtees has covered this a few times, the CEO, Capitalise. They did a study looking at the last major global recession in 2008 and 2009, and what happened to businesses during that recession and afterwards. And the reason I bring this up now is that although we're not technically in a recession, it has felt like the last year or two that there's been all sorts of challenges for businesses, and your clients will be in this kind of position where they're having to make decisions that are unusual. They're not because of anything that they've done. It's global things that are affecting their business. And so they have to make some strategic decisions and think about how they're going to go forward with the business. And what this Bain study showed was that in the last recession, and it happens with all the recessions that have ever been, is that there was always some winners and some losers. And there's only about 10% winners, and there are about 90% losers. And what does that mean? It doesn't necessarily mean that the business, the 90% all go out of business. It's not going to be that catastrophic, hopefully. But what it does show is that those that don't grow during a recession continue not to have growth going forward for, a good 10, 15 years afterwards. Whereas those that do grow during the recession continue to have a really positive growth rate. So whilst we're in these tricky times, if you can build your clients' confidence and give them the data they need to be able to make the decisions to help their business grow despite what's going on, then they will continue to grow. And that means that they will be more resilient, they will be better quality clients, they will keep paying you fees. And you've got more success stories in your practice. And that's what we all want, isn't it? We all want successful clients that are growing despite everything that might be going on. And what I also wanted to show you was the difference between smaller businesses and large businesses, large corporates. And this is a Bank of England graph that I check on every few months because it's absolutely really insightful. So the orange line represents SMEs and the purple lilac-y line represents large corporates. Now, it goes back to pre-COVID times. And if you have a look there at April 2020, you will see that there is a sharp increase of new lending requested by large corporates, large business. They went quick. As soon as they saw COVID was about to happen, they reacted and they borrowed. And therefore, the growth of lending to large businesses went up. But look at what's happening to the SME line. It doesn't react as early. It didn't react really until about July. And then it did go big, obviously. And in July 2020, what came in was the bounce back loans. So it made it much easier for them to borrow. And obviously, CBILS had been in a little bit before then, but that was trickier at first. And so eventually, the SMEs jumped and then brought finance into their businesses, but they waited. There is a lag. There is always a lag between the large corporates making decisions and when the SMEs finally react. And what that shows you is that large corporates use finance in times of stress. They bring cash flow in as soon as they think there is going to be a tricky time for that business. They bring all the working capital in as they can possibly find to give them that resilience and to allow them to make decisions and stay agile. And you'll see that if you look at very large businesses' balance sheets, if you look at PLC balance sheets, you will see that there is a lot of lending. All the assets they have, they leverage to make sure they bring in as much working capital as possible. They use that cash then to bring in more margin to the business and more growth into the business. So you've got to see funding and debt as a positive thing if it's used well. And that's really always been the philosophy of Capitalise, is that healthy funding helps businesses grow. Because if a business doesn't have funding, then it's absolutely bootstrapped and it's going to be waiting for the profits to churn through before it can then reinvest those and go again. And that organic growth and that slow burn takes a long, long time. So if you just carry on then along the timeline, so eventually the COVID borrowings came down. But if you then look to 2022, you will see another peak for large businesses that started to increase again, but small businesses didn't react. And that was the start of the Ukraine war and the energy shock with the supply chain and the oil. So large businesses reacted, and then it came away again. And then you'll start to see then April 25, it starts to go up again. In fact, it actually started towards the end of 2024. And why was that? Well, that was because President Trump got elected. And in April 25, that's when the tariffs came in. So that's where you see that peak immediately because all of a sudden larger businesses are recognizing that this could cause problems for their supply chain or their margins or their logistics operations or whatever it may be, and they needed cash in. So it went up. It wobbled around a little bit then, I think probably because maybe the Venezuela war had a bit, the Venezuela attack had a bit of an issue. And then January 2026, it's going up again. Now, of course, with that could well have been Venezuela. It could also be that they just saw the geopolitical unrest that was happening. And now, of course, we will see this eventually, the impact of the Iran war eventually will come through into this graph later. And this is where businesses are also really worried. Now, just literally heard from the CEO, Paul, just 5 minutes ago, and he was saying that, Bank of England are now pricing, well, the markets are pricing in 2 to 3, they were pricing in 2 to 3 cuts, and now they're expecting that there's going to be some hikes, interest rate rises. So we're still, hoping that isn't going to be the case, but bear that in mind, that things may be changing, and the Bank of England are quite concerned about it. And Paul was saying, and Nick, you might be able to come on to this a bit as well, is that we're seeing now funding requests are increasing because goods are stuck on the water or the supply chain is being impacted. And we started to see that in the last week or so. Have you recognised some of that's going on?
Yeah, definitely. It's becoming more and more common as a loan reason, and it happened also a few years ago when the Suez Canal was blocked as well, and then
Yeah.
everyone was coming in for those loan reasons. It has a massive effect on supply chains. So businesses have to think differently. Suddenly they're not getting stock in, so they can't cover overheads, and like, it has a whole ripple effect. So yeah, we've certainly seen a spike in loan reason for that.
Interesting. Right. So we need to keep an eye on that. So these are the things that are going to be affecting your clients at the moment. Now, something else I just wanted to bring in is that what's happened to the lending market over the last 10 or more years. There has been a complete shift, and you'll know this, that the big four banks, big five banks, used to be responsible for up to 70% of small business lending. And that has changed because the government have initiated schemes and encourage smaller lenders, fintechs, challenger banks, all to become bigger and get some more share of the market because they didn't want the monopoly to continue. So indeed, what has happened is if you look at that light blue line, that's the challenger and specialist banks lending in the SME market. Now, it did fall down dramatically in 2020, and that was because COVID, the CBILS loans at first were only it was only the larger banks that were eligible to offer the CBILS loans. So it wasn't until later on in 2020 that the fintechs and challengers were authorised to allow those CBILS, and then of course bounce backs as well. So there was bit of a blip there in 2020, but you can see that the increase has continued up until this report only came out this week on Tuesday. This was covering late 25 and early 2026, and it's showing that now challengers and specialist banks take 60% of the lending of all SMEs. Now, what does that mean? So we know that these are banks that haven't got big head offices and branches, and they're not the tier one lenders, the Barclays, the Lloyds, and so on. They work very differently. They're using digital systems. They have less staff. They are really making use of the technology. And what that means is that they are assessing the application in a very different way to the way that the banks used to do it. And, so we don't anymore send big business plans out to lenders and get them to read through it all. We don't send it out to just two or three. We are able to put this proposal out to a number of lenders all at the same time that are relevant for this particular application. But what they're doing is looking at data in a very different way. They're not looking at business plans, they're not looking at projections, they're looking at credit scores. And this is where the credit score becomes so much more important than it ever has been in history and will continue to be a data point, which is really incredibly important. So I'm going to come back to credit scores in a second. So that's kind of the global picture and the market picture. Let's go on to think about what your clients are actually talking to you about or the funding needs that they have. And these are the discussions that you want to be having with them. And if it makes it easier, put it into an agenda for you, put it into meeting points so that for you and the rest of your team, so you know that they're having these conversations and you're having these conversations with all of your clients because they will really appreciate these conversations with you. Now, it might be that they're launching a new product or they're going into a new territory, or new area of the market. It might be that they need finance because they're going to renew their vehicle fleet or they need to replace plant and machinery or equipment. They might want to refurbish if they've got offices or retail premises. They might be thinking that they've got lots of different facilities, and they might want to consolidate them and bring them into one facility so that they can just have one payment going out, and see if they can make that any cheaper. More unfortunate, those are all really good positive things, but unfortunately, you'll have some more negative things. So you've got those that are struggling to pay payroll, or they're worried about being able to pay their suppliers or their VAT bill, or they've got a potential bad debt, and that's worrying. They're going to have to write some debt off, was profit and cash that they were expecting to bring into the business, and they're now not. Then it might be much bigger, so it might be they're looking to buy a new building, or it might be that they're looking to buy another business. And that's really what I get involved in, corporate finance, or buying out a partner or an equity shareholder. So that might be much bigger amounts of money. But whether it's smaller working capital, whether it's asset finance, whether it's a larger structured debt, there's all sorts of needs that your clients have, and they want you to be able to talk to them. What do we see the most of, Nick, of these?
Yeah, good question. I think to be it's kind of I'd say I'd group it up. So the most common reason that we typically get is cash flow. So that can be things around, payroll, VAT bills, stock. So there's a whole series of reasons, but it's typically those shorter term working capital reasons. Um, yeah,
They come up more often, don't they?
yes, I
Those,
think
those,
so.
yeah. So the bigger things like buying a building or buying a partnership or buying a partner or buying a business, they're obviously going to take much longer as well to put together, and there'll be lots of negotiation going on in the background as well by the business owner. So definitely conversations that you want to get ahead of. And why is that? Well, if the client is quite reactive about their need for finance, so whether it's the running out of cash for stock or the VAT bill or the payroll, then if we're asked to respond quickly, that typically means it's going to be very expensive, because there's only a certain type of lender that we can go to that will respond very, very quickly, and they'll know it's crisis funding and they'll price accordingly. So that's not great from a cost perspective. It will always be more expensive if you're having to react really quickly and not have much time. It also means that your client isn't very clear in their strategic decision making. They're under pressure, they're just reacting, so they're not going to make the best decisions in those cases. And generally, whether it's you or your client or us, we're all under much more stress if we're being asked to do something which is very urgent. Whereas, obviously, if we have more time and you have more time and your client has more time, then you can assess more options. You've got access to better rates and better products and better lenders, and the client eventually will be able to achieve what they're trying to set out for, rather than it all just being a panic. If the business owner is declined because they just haven't got the right proposal for the lenders that we are accessing, then that makes the client really depressed, and it becomes a real kick for them. So emotionally, running a business owner needs to be on it all the time, don't they? And when they take an emotional hit or they're dejected, then that affects the way that that business performs. Secondly, it will impact the credit score. If they've had a rejected lend, something's been turned down, then that is going to show on their credit profile, and that is going to bring their credit score down. So if we are going out to the market and there are going to be full credit checks on the client, then we want to make sure that one of those is going to be positive. And then it may become your problem because, and I've been in this situation where client isn't able to make a VAT bill, isn't able to make payroll, and there's a big panic. You can't find the finance because they've just left it too late. And then it all gets dragged into you being part of the issue. The clients saying, well, why can't you do what you said you'd be able to do? And and so as a client service, it's an awful situation to be in. However, if you do manage to find the funding for them and it's all done in an organized way, then you become the hero. You're the one that solved the problem. You've presented them to Capitalise, who have been able to find the finance appropriately. You, as a firm, will also get commission for that, so it'll be a revenue stream. And it's just a great feeling when you've really helped a client out. And we have every week, we talk in Capitalise all the successes that we've had. And it's brilliant to see the real world impact of what you've done, whether that's being able to open another second retail premises, whether it's being able to grow the business, going into a new area, or do a marketing campaign, and then we start to see the growth. That's what we're here for. That's what you want to be here for, is to help your clients succeed. So let's try and make sure that we get in front of these conversations as early as possible, and we give your client the best chance to have the right result. Now, the most common decline reasons we see, and I'm going to ask Nick to elaborate on this a little bit as well. Um, if the client's already got a poor business credit score or poor personal credit score, if they're a small business, their personal credit score will also come into the decision. Then that's just something that exists historically, and that will cause you an immediate problem as to where you can go. So, Nick, this is a pretty major thing that we see, isn't it?
Yeah, I often describe this one as the first hurdle to
Mm.
funding. If we can't, if the personal credit or the business credit doesn't meet certain thresholds, depending on which lender you send it to, then it's very much the quick, straight away no without looking at any of the financial information. Not all lenders operate like that. We've got a very select few that might not have a minimum business credit score, but naturally they are more on the expensive side of things. So yeah, I normally describe this one as the first hurdle.
Yeah. Now the personal credit score comes into effect for the smallest businesses, doesn't it? Because they will wrap up the personal credit score as well as the business credit score.
Yeah, it does, but even on the bigger businesses, because what the lenders, that quite often as an objection we'll get from clients, being like, well, you're lending the money against the business, not me personally. But the lenders want to understand who is behind the business, who is running the business. And if you've got like a strong business, but one of the shareholders is like a CCJ or defaulting on the mortgage or something, it can reflect badly on the business as well. So personal credit is super important.
It shows behaviours, doesn't it,
Yeah.
really, and risk. And then affordability. So what do you mean by affordability? I know you're going to come into this a bit more detail about what lenders specifically look for, but we're talking here about profitability.
Yeah, it can be whether they're profitable. Some lenders will happily look at loss-making businesses, so therefore they calculate their affordability on turnover, minus any existing debt that might be in the business as well.
Okay, but certainly, if they are loss making, that means we're more restricted in terms of the lenders that we're going to go to. But not to say we
Correct.
can't do it, but it obviously makes it harder. So trying to get your clients profitable and growing is obviously a key thing for all of us. Bounced and missed payments. So, direct debits being returned, or they've exceeded an overdraft facility, or again, a real issue. Nick, what do lenders think about this?
Yeah, like this is again, this is a difficult one because a lot of lenders will have hard no's when it comes to bounce payments. So if you have a certain amount of bounce payments in the last 6 months business bank statements, a lot of lenders will just give it as a hard no. But it's a bit of a catch 22 because it suggests that in not in all instances, but in some instances, some of the bounce payments could be because they're not getting the cash in fast enough.
Mm.
So actually they need it for cash flow, but unfortunately it's quite black and white when it comes to the lenders. I think quite where lenders can be a little bit more flexible on this is actually some invoice finance products. And that way actually gets the cash in early. So then it avoids bounce payments going forward.
Yeah. So again, if we can get ahead of these happening, or if you see that one has happened, then you need to jump in and say, can we stop another one happening? So that we don't want it to become something that's happening regularly on those bank statements. So spotting those early and getting ahead of this conversation will really help your client. If your client has already approached several lenders, or they've found a broker or whatever and they've gone out to lenders, that does restrict what we can then do, because it shuts those lenders off to us. So try and make sure that your client's not already going out to market themselves and then coming to you as a last resort. Make sure that they're aware that you're capable of doing all of this work for them, and therefore just to let you take care of the whole thing. High level of existing debt, so they're already leveraged too much. They've got lots of different facilities. That is also a warning flag as well. Lack of and unwilling to provide security. So this comes down to both the corporate security, but also the personal guarantees. So Nick, talk to me about personal guarantees.
Yeah, so again, as you can imagine, it's a big objection, and you completely understand why because it's literally tying the whole point of a limited company is to have limited liability. So you're tying in the shareholders into that. However, the fact is that majority of lending that's done in the UK will be backed by a personal guarantee. So if shareholders, directors are willing to provide personal guarantees, it's going to give them loads more options. Now, we do have some options that don't require a personal guarantee, but it's often shorter term. It might not be the exact sort of facility that you want, and it is for the strongest of businesses. And even some of the strongest businesses don't get it because they might be in a higher risk sector or something.
Mhm.
And as a final piece, if you've really got clients that are totally against it, we do have a provider that can provide personal guarantee insurance. And you're not fully covered for the whole amount, but it does significantly reduce the liability, and it might just give people peace of mind as well.
Yeah. I mean, I remember when I was in practice myself and having these discussions with clients, and what I used to say to them, that often the personal guarantee is there just to show a willingness to the lender that you will stick around as a business owner, so that if there is, a crisis and you're not able to repay the facilities, that you will stick in and you will help the client. Sorry, you will help the lender recoup as much as they possibly can by bringing, chasing your debtors to get them in, and really do everything that they can possibly do to make sure that the lender has as little loss as possible. So that's really why they're asking for personal guarantees. So it's just a commitment that they're not just going to jump ship and then leave everybody else to sort out the problem. And then loan reason, oh sorry, up-to-date documentation not supplied in the correct format. So they can be quite stiffy about this, can't they? They don't just want Excel spreadsheets or screenshots, or what's the most common request that they have?
Yeah, look, obviously every lender has different document requirements, but some lenders will only do like open accounting links, open banking, and if you can't get that, there's no alternative. So really, it would decline it straight away. So businesses that aren't using those services, whether through their bank or their accounting software, then they won't actually have access to certain lenders. And then yeah, just the format of where the documents are in, like Excel, obviously can be tampered with, and not a lot of lenders will accept those. So typically it's in PDF format.
PDF form that's showing the bank details and the company name and the account number and all the dates and so on. Yeah. And then loan reason not appropriate for the product or the lender. So just matching the right reason with the right lender or the right product. Now, what you see in here is that we've got 130 lenders available to us at Capitalise, or more than. And there is definitely different needs and different requirements by each lender. And that's what Nick and his team are absolutely brilliant at. They meet the lenders on a regular basis. They completely understand which lenders will match up with which product, which company, which situation. And that's why it's really important that you try and get this information into us as soon as possible, so that we have as much time as possible to look at the whole market for your client. Now, I just thought I'd throw a question out. I'm not going to do a poll on it or anything, but if you were to just imagine, what percentage do you think of your clients know their credit score, of business owners know their credit score? Now, there has been some data on this that's come out in various different guises, but I don't believe any of it, to be honest. So let me tell you why. So money.co.uk did a survey, and they said that 55% of businesses said they knew their credit score. Now, I don't think that's the case. I think that's a very restricted population that they've surveyed, because if they're on money.co.uk, they're probably looking for finance. They've probably already gone and checked their credit score out. So therefore, that 55% I think is pretty inflated. The British Business Bank, their report has said that 67% have never checked their business credit score. So in other words, only 33% know it. So I think we're getting down to more reasonable figures here. And Capitalise, we did a Fit for Business, if you remember, Fit for Business survey a couple of years ago. And they, in that survey, business owners was saying 29% of them knew their business credit score. Now, I think it's probably across the whole population of businesses, even less than that. I think so few business owners know their credit score, but it is something that they really need to understand more and more about, given the way that the market and lending has now gone. And I'm sure you'll know this if you've been working with Capitalise for a while, but the reason why credit scores are so important is, as Nick said, it's the first stage. It's the hurdle we've got to jump through to make sure that we can actually even approach these lenders with a certain credit score. As I've shown you, the lending market has changed. So now we're dealing with challenges and fintechs that are digital-led businesses, and they're focusing on credit score more than the tier one high street banks used to ever do. There is a minimum hurdle for certain lenders. It definitely dictates how much it's going to cost in terms of interest rates. And also, we know that business owners that monitor their own customers' credit scores mean that their own credit score is 6 times more likely to be in the top credit band. So good behaviours. Excuse me. So, Nick, I'm going to ask you to pick this one up. Will I just have a cough? A credit review service. Explain about this 12 months rolling average and which lenders prefer 12 months. And oh gosh, my voice is completely gone. You take over on this slide.
Sure, no worries, no worries. So the 12-month rolling average piece that like Kirsty was mentioning is some lenders will simply look at your credit score and what it is on that day of receiving the application. So if it's 100 out of 100, but over the last 12 months, the average is 50, they will look at the 100 and be like, this business has a credit score 100 out of 100, tick. Other lenders will look at what we call a 12-month rolling average. So if your score is 100, but the average has been 50 over the last 12 months, they will take 50 and then that's the score they will go with. So I think quite often, in order to make sure that we can cover all bases and try to get the application in the strongest possible position, it is about having the average as high as possible. So using the CRS perhaps just after a business files their set of accounts, because typically, not always, but typically when a business files their set of accounts, the credit score goes up. And then if we do the CRS, we can almost get it like a double bounce. That way, it will stay as strong as possible until the next event that can affect the credit score, which typically is the filing. Obviously, there's other things that can happen in the meantime if you get CCJs or whatever else, but doing it as soon as you file tends to be the strongest point.
Brilliant, thanks. Yeah. So doing the credit review service, obviously, just after you've filed accounts is ideal. And then recognizing that that might not mean that we can immediately go out to all the lenders if it's got high credit scores. So just bringing this into your regular annual checks that you're doing with clients anyway. I know some firms are bundling this up now into a service package. So they make sure that their client is getting a CRS, checking that their credit score is as high as it possibly can be every single year. And then that just rolls on then, and it means that we are in the best position possible. Okay, so let's go into a bit more now about the oh, sorry, I've got this one first. So apply without support. If your client goes to the lenders themselves, then you can see that they might not know their personal and credit score, business and personal credit scores. They might not know that they have applied to the right lenders. They don't know that they're able to supply the right documentation in the right format. Just having all this extra information as specialists just really helps with the application process. And then one thing to really be aware of, if your clients are using brokers or are going through other like websites, then you don't know whether they are being I won't say scammed, but that they're being added on lots of extra fees. And we see some shocking things that come through where the client doesn't realize how expensive that product has ended up being because the brokers have put different fees and they'll call them different things as well. So it almost looks like it's the lender that's putting it on, but sometimes it is the broker that's putting those fees on directly as well. So just protecting your client and making sure that they don't end up in that position means that if you were to take more control over their lending and their funding needs, then you can support them through that. So Nick, let's run through this slide for me. So we talked about affordability. Just give us a bit more information about different lenders and what they look for.
Yeah, sure. Thanks, Kirsty. So, look, we feel like before we send an application out to market, if we can get green ticks on all of these, that we're really confident that that the team can go out and get an approval on the case. Obviously, we're not magicians. Like we can't just get everything approved as much as we'd like to help. But we feel like if we can get these and they kind of meet those criteria, there's a really high chance. So affordability, we did touch on. So affordability is typically done in two ways. So if we're going to some of the challenges or the high street, and for like quite a big loan, so normally anything above 250, 500K, the way that's calculated is typically anywhere between 1 to 3 times EBITDA minus any existing debts. But then some of the kind of like the newer lenders and the ones that will help with smaller businesses will look at a revenue-based model, which is anywhere between 10 and 40%. Again, minus any other debts in place. Um, just in terms of existing debt, it's really useful to understand upfront what debt the business has in place. Now, the lenders can see it in the bank statements, they can see the repayments, and so they know it's there. But actually, having all of the details beforehand just saves a lot of time. So typically, we'll get out a debt schedule where we can identify the original balance, the outstanding balance, the term, interest rate, and the lender. And that way, when the lender sees it in the bank statements, they can match it up to the debt schedule, and they don't have to come back and request for more information. So that really does save a lot of time when we're sending things out. Typically for businesses with a lot of debt, if there's like one or two loans, like you might be able to get away with it if they can see there's a lot of extra affordability. But typically if there's kind of like 3 or 4 plus, that's where we'll need that to come in. Documentation. So we kind of like touched on this earlier, but like it's just making sure there's absolutely no gaps in bank statements. Open banking is preferable. It might mean that we have to do like multiple links for each and every lender, but it does mean that the data kind of isn't the cleanest format. And then most lenders require everything in PDF. So that's not just bank statements, that's also, company accounts, management information. The other piece I'll say around documentation as well is the more up to date it is, again, the higher chance we can get that approval because it means we can go to more lenders. If we're dealing with data that's, if we're getting quarterly MI, I appreciate not every business does that, but if we're getting quarterly MI, then we're winning because we can really give them the most up-to-date information. If their last filings are, kind of like 6 months old, 9 months old, then we can also go to majority of the market. It's when it starts to get a little bit longer, so we're looking at 12 months and things, that it can be challenging. Still go to some lenders because a lot of lenders will look at the bank statements. But we just want to make sure that we can try and get as many options as possible for every client that comes to us. And security. So we touched on PGs, but really what we want to understand at the beginning of the application, what is and isn't available. Obviously, the more security they have, so if there's, charges on balance sheets, assets, property, PGs, then we're going to have more options available to that business, and we're going to be able to really go far and wide. The less we have, the less options we're going to have available. So it's just really understanding what is and isn't available at the beginning. There's nothing worse of going out to market, and then the client turns around and being like, look, I don't really want to sign a PG, or I don't really want to use these assets as security. Like, because if we can work that out at the beginning, then obviously we can make sure we're putting it into the right places. So I think that's kind of it in terms of how we want to see what we want to see from applications at the beginning. And like I said, like if we can get a lot of these green ticked, then there's a high chance that we can get approvals.
Brilliant, thanks. And then I asked you to provide a case study. So this is an example of something that we've done for a client recently. Do you want to just talk through this case?
Yeah, sure. So this is a business that had come to Capitalise, and prior to coming to Capitalise, they had gone to go and get funding themselves. So they'd gone direct to a lender. Now, obviously, every business owner needs to do their own research and check and go out and try and find the best solution for their business. I think the challenge that happened in this instance is it was one of the first ones on the Google page, meaning the lender with the deepest pockets. Um, and they came back and gave an initial offer 50K over 12 months. Now, the business actually wanted a higher loan amount over a longer term, but the lender couldn't offer that. And I think it was one of those scenarios as well where they didn't actually have much human contact with that lender, because it was kind of like given to them, the offer was given to them on a portal. Um, so there wasn't loads of options available. But when they came to Capitalise, because we have that understanding of affordability and like once we reviewed all of the documents, we actually thought, we can take this out to other options to the market. We can get a longer term. And we think based on your turnover, we think we can get a higher loan amount as well. And that was exactly the outcome. So we're able to get them an additional 40 grand with a lower rate over a longer term. And this is quite a common scenario that we see at Capitalise. Like there's lots of lenders that businesses will know because lenders obviously market them directly and they come to us with offers, and we're totally fine with that because we feel like we have a really good understanding of the market. We can review the business, and sometimes we're like, no, that is the best offer you're going to get. If you want to take it, go for it. But many times we feel like, yeah, we can beat that, and we can try a different option. So it's always worth having a conversation, even if they think they have what might be the best offer.
Yeah, I know I've done that in the past with businesses that I've known, and I've put them into Capitalise to say, just sense check this offer for us.
Yeah.
Is it the best that they can get in the market? Is it a decent offer? And sometimes it's come back yes, and other times it's in, well, we can actually probably do something else for you. And
Mhm.
I think you said a key thing on here, which was that there was no human contact, and that I think makes all the difference. It's not a case of just putting everything into a computer and the computer says no or the computer says yes. It is getting behind the business and asking the right questions, and that's what you and your team do. That's why you have the phone calls with the client to really understand everything about it, so that when there are no shocks when we go to the lenders, but also just it could like just trigger something else. Well, actually that would be more appropriate, or that fits better. Understanding what the client really wants the money for, and how the cash flow might work is also really important. Yeah, because this one, it suited their cash flows better going out over 36 months.
Exactly.
Yeah. Okay, thank you, Nick. Right, really useful. So, just something to help you here. Coming soon in April. I can't give you an exact date, or else I'll be shot. But we're hoping from early April that you will start to see this in the capital report. So the capital report is a great tool to discuss with your clients on a regular basis, whether you do it as part of the annual accounts process or quarterly check-ins with your client. Just sharing the capital report with them means you can talk about credit scores. You can open the conversations for lending. It just gives you something to have in your hand or on the screen to use as a guide. But what we're putting in there are some things to help you. So we are going to be you'll see on the platform at the moment that you can clients can be pre-qualified now for funding, and that is going to be going into the capital report as an option to be able to show your client. So for those that they know that they're more likely to be accepted, they've already been pre-qualified, that just gives them a little bit more comfort that they're not going to be wasting their time. And they can start to see the rates and things, and the product that might be offered. And also another nudge about the credit review service for your clients. So it allows you to discuss it again with them, just to make sure that they understand it, why it's so important for us at Capitalise. So we're trying to work with accountants to make sure that your clients have got, the healthiest lending possible, so that it helps them grow their business without killing their business with the expensive rates, and that they're actually able to make a return on investment on that borrowing and that debt to grow their business and add more margin to the bottom line. So we've got to make sure that longer term, all our clients have got the healthiest lending possible. So those are some of the things that are coming up. But in terms of then you being able to support your client, then just getting in front of them, being proactive, having these as agenda points, meeting points, that things that you're discussing with them regularly, whilst you're already discussing other things, whether it's the accounts, whether it's the payroll, whatever it might be that you're there to do on the compliance side, bring in these advisory questions as well. Hopefully now you understand the most common decline reasons and you can help your client avoid those. We understand how important credit scores are and how to use the CRS. And yeah, just regularly ask them about their own funding needs. What is it that they're going to look to do? What's coming up for renewal? What assets are they having to invest in? Are there any markets that they're going to go into? And open up all those commercial conversations with them. The client will love it, really appreciate it. And you, as you know, will get much better relationship with your client as a result of that. So we're going to leave it there. Thank you very much for joining us. Our next session in third Thursday in April is with Toby, Senior Partnership Manager, and Toby and I will be discussing the regulatory aspects and the FCA aspects of lending and what it means to you as an accountant and where it is that Capitalise as a platform protects you on the regulatory side. So I will see you in April. Thank you once again, Nick, for joining us on this first session of the new season. And I think we'll get you back again later in the year to talk about something else, but really appreciate all your expert knowledge today. Thank you.
Awesome. Thank you very much. Pleasure as usual, Kirsty.
Speak to you all soon. Bye.
Cheers. Bye.